A few months ago, I started transferring one of my old workplace pensions into my main pension account. And when that completes, as it transfers as cash, it's going to leave us in a very unusual position. Across all of our pensions, we'll be holding close to 80% in cash. Now, at first, that might seem quite sensible. Cash feels safe, especially when you're only around 4 years away from our planned early retirement date. But I don't think it's going to provide the opportunity to maximise our returns in a safe manner. So now it's time for a reboot and to create a strategy that will take us into our retirement years. So in this video, I want to show you the options that I'm looking at, the investments I'm considering, and genuinely ask for your thoughts, because many of the decisions we've made over the past 6 months have been shaped from comments from all of you fantastic people out there. And this is another one where your experience could really help. If you enjoy looking at pension numbers, investment choices, and planning for retirement, this could be right up your street. If not, then there's a fair chance that this video could also help you in another way. It could help you fall asleep. So, at the moment, most of our cash is split between two places. A small amount is simply sitting in the SIPP account as cash, which currently pays just over 2% interest. So that's around £5,000 that we have there. So not huge, but still not a great return that's been generated. The much larger amount is in a money market fund called CSH2, and it aims to reflect the short-term interest rates, which is currently giving us a return of roughly 4.2% per year. That's been pretty good over the past few months, and compared to the standard cash account, it's clearly better. But there are two reasons I don't want such a large percentage of our pension sitting there. The first is simply concentration risk. We have far too much of our retirement pot in one place. And the second is that whilst it's a relatively low risk fund, it isn't protected in the same way as cash deposits. I don't think there's likely to be a problem, but I also don't want to have all of our eggs in one basket. So I've started thinking about stage one of a broader plan. At the moment, I'm not looking to put more into shares. That may happen later, but right now I want something that gives us a better return than cash while still keeping a defensive position. That led me to UK government bonds, which are called gilts. And when I looked at the current UK gilt yield curve, something really interesting stood out. Once you go beyond roughly 12 years, the yields rise above 5.5%. That's a significant jump from the 4.2% that we're currently getting in the money market fund, and far above the 2% on our basic cash balance. So my thinking is this: because we won't be drawing from our pensions for about 4 years, and even then we'll likely draw down gradually over the following 10 years, we have a reasonable time horizon. That means I'm considering moving part of our cash into a mix of two gilts with different maturity dates. But before I do that, I've got a question that some of you may know far more about than me. If I buy a gilt today with, say, 15 years remaining and hold it for 5 years, then effectively it becomes a 10-year gilt. So if the UK gilt yield curve stayed broadly similar, would that mean that I not only receive the annual yield, but potentially also gain from capital appreciation as the market price has to adjust to effectively what's the 10-year yield rate and reflect the lower yield on shorter dated gilts? So that's one of the key things that I'm trying to fully understand right now. The second question is around duration. Even though our maximum likely time frame is about 14 years, is it still sensible to buy a gilt with 20 years or even 25 years to maturity if the yield is significantly better, knowing that we could always sell it before maturity? I mean, the obvious risk is that if interest rates rise sharply and stay high for years, because then that could push down bond prices to significantly lower levels. Personally, I don't see that as the most likely scenario, because significantly higher interest rates would probably hurt the wider economy, and it would potentially trigger the sort of slowdown that eventually leads to rates coming back down. But I may be missing something, so I would really value your views. At the moment, I'm thinking about keeping our portfolio split like this: 40% in the money market fund, 20% already in shares, I won't be selling any of those, and 40% moved into gilts. And that 40% gilt allocation would likely be split equally between two different issues. The first one I'm looking at is a 2038 UK Treasury, TR38, and that yields 4.75%. It matures in December 2038, so just over 12 years away. It currently trades below £100, which means in addition to the coupon payments, there's also capital growth if held to maturity, taking the effective yield to around 5.5%. The second is a 2043 UK Treasury, TR43, that also yields 4.75%. That matures in October 2043, so around 17 years away. And because it's trading even lower below par, the effective yield is slightly higher at around 5.7%. There's also one that really caught my eye, a 2056 gilt, T56, that pays a yield of 5.375. So that one looks incredibly attractive on paper, with a yield to maturity of around 5.8%. But the maturity is around 30 years away. And that feels a little too long for me. The risk there is that if we needed to sell at the wrong time, and effectively we would be forced sellers as we're looking to get rid of all of our pension in around 14 years' time, then we could take a loss, and it could be a big loss. So right now, I'm leaning towards the 2038 and 2043 options. But I would genuinely like your thoughts. If this was your pension and you were around 4 years away from early retirement, would you keep more in cash, move part into gilts now, or start buying more shares instead, even with the markets at their current highs? And do you think gilt yields are attractive right now, or do you think they may rise further and create a better buying opportunity later? One thing that I do like is that by keeping 40% in the money market fund CSH2, it still gives us the flexibility. If markets fall and I feel shares become more attractive, I could move some or all of that cash into our existing share allocation. That means potentially increasing our total equity exposure from 20% to as much as 60%. So this feels like a useful halfway step. Earning more than cash now, improving diversification, but still keeping the options open. I know this video has been a bit more technical than usual, so thank you if you've stayed with me this far. And as always, I really appreciate all the comments, and several of your suggestions over the past few months have genuinely influenced our retirement plans. In fact, in the next video, I'm going to look at exactly how this channel and your feedback has changed our retirement decisions over the past 6 months. And when I started listing them out, I was surprised at just how many there were. So thanks for watching, and I will see you in the next one.